Hello everyone and welcome to another stock market analysis video here on Momentum channel. My name is Mo, and in this video we'll introduce two undervalued healthcare stock that exist in the stock market right now. Both of these stocks are showing an upside potential of about 15 to 20%, and both of them are a dividend paying stock. So let's get into it. The first undervalued stock to review is Novartis, which is traded on New York Stock Exchange with ticker symbol NVS. It was last traded at the price of $84.13, but it's showing a fair value of $100.71 based on its real or underlying intrinsic worth. This shows an upside of 19.7%, but with a low level of uncertainty, making it an enticing undervalued pharmaceutical stock in the healthcare sector to buy or add to your watch list right now. The fair value is calculated based on Finbox fair value methodology and allows investors to find companies that are being traded at a margin of safety compared to their fair valuation per share. Similarly, the analysts at TipRanks have a one-year price target of $99.52 for Novartis stock. The stock is showing a forward price to earnings ratio of 17.85 based on generally accepted accounting principles. For your reference, forward price to earnings uses forecasted earnings for the price to earnings calculation. It is used to value companies at their future level of earnings. A lower forward price to earnings ratio suggests that the company is being traded at a cheaper valuation. Looking at Novartis financials, we notice that company's trading 12 months revenue is at $49.8 billion, showing a steady growth over the past 3 fiscal years. Their net income, on the other hand, has been declining over the past few years and shows a trading 12 months net profit of $8 billion compared to $11.7 billion net profit in the 2019 fiscal year. We believe these declines have been baked into the stock price of Novartis. Ideally, we would like to see the company continuously increasing its revenue and net income. Nonetheless, Novartis is estimated to have a revenue of 52.3 and 54.3 billion US dollars in 2021 and 2022 respectively. As for companies' balance sheet, their trading 12 months current liabilities exceed their trading 12 months current assets, which is a little bit of a red flag. This results in a current ratio of less than 1 for Novartis, suggesting that the company may not have enough resources to meet its short-term obligations. However, the company's total assets well exceed their total liabilities, which is a positive sign on their balance sheet and reassures investors about the previous red flag. The company is also showing a positive free cash flow of over 12 billion US dollars, mostly generated from its operations, which is a positive sign. Looking at the peer benchmark review, you'd notice that the company Novartis has a market capitalization of over 189 billion US dollars. Novartis stock had a one-year stock return of 8.4% compared to an average of 25.8% return for the healthcare sector. From a stock volatility perspective, this stock has a beta of 0.48, which is less volatile than the beta of 0.75 for the healthcare sector, suggesting lower levels of volatility in the stock price for Novartis compared to the healthcare sector. Beta is a measure of volatility or systematic risk of a security or stock compared to the market as a whole. A beta of less than 1 suggests generally less volatility in the stock price compared to the overall market. Novartis International is a Swiss multinational pharmaceutical company based in Basel, Switzerland, and it is one of the largest pharmaceutical companies in the world. Novartis does pay a dividend, and its dividend yield is currently sitting at 2.47%. It has a dividend payout ratio of over 86%, which is a bit high and risky, but they'll have been paying their dividend for the past 22 years. What's more, they have grown their dividend consecutively over the past 2 years. Looking at Novartis' last quarterly earnings report, which was announced on January 26, the company had earnings per share of $1.34, which showed a negative 3.8% surprise compared to analyst estimates. The company reported revenue of $12.77 billion, which slightly missed analyst estimates by 0.8%. The date for the next quarterly earning is yet to be announced, but the company is estimated to report revenue of 12.58 billion US dollars. You can see how stock price has reacted after earnings report for Novartis. Within the past 8 quarterly earnings, the company's stock price has decreased 4 times after the earnings report was announced. This is despite the fact that for most of these quarterly earnings, the company had surpassed analyst estimates for the earnings per share over the past 8 quarterly earnings season. Looking at the stock price versus the 50-day and 200-day simple moving average, you'd notice how the Novartis stock price is now below both of these moving averages. The second undervalued stock to review is a company called Pfizer, traded on New York Stock Exchange with ticker symbol PFE. It was last traded at the price of $34.94, but it is showing a fair value of $40.02 based on its real or underlying intrinsic worth. This shows an upside of 14.5% growth, though with a medium level of uncertainty, making another enticing undervalued stock to buy or add to your watch list right now. The fair value, as we touched on earlier, is calculated based on Finbox fair value methodology and allows investors to find companies that are being traded at a margin of safety compared to their fair valuation per share. Similarly, the analysts at TipRanks have a one-year price target of $40.33 for the Pfizer stock. Looking at Pfizer Financial, we notice that company's revenue has been steadily growing over the past several fiscal years. Their trailing 12 months revenue is at $41.9 billion, showing a 1.7% increase compared to previous fiscal year. Pfizer's net profit is at $9.6 billion US, which shows a decline of 40% compared to previous fiscal year. However, the revenue projection for Pfizer is showing an estimated 48% increase to reach $62 billion US in 2021, though the revenue in 2022 is projected to cool off and reach $53.3 billion US. As for Pfizer's balance sheet, you notice that their current liabilities over the past 12 months exceeds their current assets. This results in a current ratio of less than 1 for Pfizer, suggesting that the company may not have enough resources to meet its short-term obligation. This is a bit of a red flag, although the company's total assets well exceed their total liabilities, which is a positive indicator for us. What's more, the company has been able to lower its total debt in the trailing 12 months compared to past fiscal year. Pfizer is also showing a positive free cash flow of $12.1 billion US in the past 12 months, mostly generated from its operation, which is a positive sign. Looking at the peer benchmark review, Pfizer has a market capitalization of over $194 billion US. Pfizer stock had a one-year stock return of 17.4% compared to an average of 25.8% return for the healthcare sector. From a stock volatility perspective, this stock has a beta of 0.62, which is lower than the beta of 0.75 for the healthcare sector, suggesting less volatility in the stock price for Pfizer compared to the sector and its peers. Pfizer is an American multinational pharmaceutical company, which is one of the world's largest pharmaceutical companies and a Fortune 500 company by total revenue. Pfizer does pay a dividend, and their dividend yield is right now at 4.46%. Their dividend payout ratio is sitting at 88%. The company has paid dividend over the past 31 years and has consecutively increased its dividend amount for the past 11 years, which is impressive. Looking at Pfizer's last quarterly earnings report, which was announced on February 2nd, the company had earnings per share of 42 cents, which showed a negative 9.6% surprise compared to analyst estimates. The company reported revenue of $11.68 billion US, which surpassed analyst estimate by 3.4%. The date for the next quarterly earnings report is yet to be announced for Pfizer, but the company is estimated to report revenue of $13.5 billion US. You can see how stock price has reacted after earnings reports for Pfizer. Within the past 8 quarterly earnings reports, the company stock price has decreased 5 times after the earnings report was announced. Looking at the actual earnings report and comparing it to analyst forecasts in the past quarterly earnings, you'd see that over the past 8 reports, Pfizer has surpassed analyst estimates for earnings per share 6 out of 8 times, and it also surpassed analyst estimates of revenue 5 out of 8 times. Looking at Pfizer's stock price versus the 50-day and 200-day simple moving average, you'd notice how the Pfizer stock price is now below both of these moving averages. There you have it, folks, my 2 recommendations for 2 undervalued healthcare stocks in the stock market right now. While I've done extensive research to put this video together, please know that I'm not a financial advisor, so kindly do your own due diligence and research prior to buying any of these stocks that we talked about in this video or any other stock for that matter. Do you own any of these 2 stocks in your stock portfolio? I would love to hear from you, so be sure to let me know in the comment section of the video. I hope you found this video beneficial and you gained something from value from it. If you did, please be sure to give it a thumbs up and share it with someone who might benefit from the video as well. And of course, don't forget to subscribe to Momentum channel. Here on Momentum, we post weekly several videos about the stock market investing, finances, and financial freedom. With that, thank you guys, and I hope to see you next time.